In this video, I'm going to explain how to safely invest money in stocks. Warren Buffett, you may have heard of him, is one of the most famous investors of all time. And something people like to quote him saying is that there's two rules to investing. Rule number one is don't lose money, and rule number two is don't forget rule number one. And just hearing those rules is great and all, but in this video, I'm going to actually explain how you can put that into practice and actually safely invest money in stocks. But before that can actually be explained to you, you first need to know the two core fundamental principles of stock investing. Now, by the way, if you have no intention of researching companies and picking individual stocks, or if you just simply know that you're not going to have enough time for it, but you're still interested in learning how to invest in stocks safely, but without requiring any time or effort from you, then the answer is very simple. Just buy low-cost index funds and forget all about it. And this is exactly what Warren Buffett himself suggests that 99% of people should be doing, rather than dabbling in individual stock picking. The only way to get the best of both worlds, where you're getting above average results while also putting in no effort, is to give your money over to a professional money manager that does understand what we're about to talk about in this video and can achieve superior results for you. The problem with that, though, is that the record shows that most money managers don't end up achieving better results than the benchmark index that they're trying to beat. And this is exactly why Warren Buffett suggests a low-cost, broad market index fund is the best way to go for 99% of people. So when push comes to shove, you really only have two options. Either you put your money into a low-cost, broad market index fund like the S&P 500 index fund, for example, or you pick individual stocks yourself. Now you might be thinking, well, wait a second. If most professional money managers can't beat the S&P 500, then why is there a point in me even trying? And the short answer to that one is that the individual investor like you and I, who is working with a small amount of capital, and by small I mean under $1 million or even under $10 million, is considered small for the purposes of what we're talking about here, well, we have some serious advantages over the large money managers. Now, this is something I talk about more in depth in this video right here, so you should check that one out at some point, but not yet, because you won't be ready to watch that video until you finish watching this video right here. In the end, whether you decide to manage your own money or you decide to put it into a low-cost index fund, what you're going to be learning in this video is 100% necessary learning if you're going to be successful in stock investing and if you're going to do it in a way that's safe. You have to know what we're about to talk about. There's just no way around it. So the first thing to understand is that when you own shares of stock, it means that you own a percentage of the company. Literally, that's what it means. It means you own the company. So all public companies have a defined number of what's called shares outstanding. And now this number is not a fixed number, because companies can issue new shares and they can also buy back shares as well. And so the actual number of shares outstanding is not what's important, because one company might have 1 billion shares outstanding while another company has 100 million shares outstanding, and that part is irrelevant. What is important to know, though, is that the number of shares outstanding is the number of shares that the company's ownership has been divided up amongst. So literally, if you were to own 1% of a company's shares outstanding, it would mean that you owned 1% of that company. If you owned 1% of Coca-Cola's shares outstanding, you would own 1% of that company, Coca-Cola. Okay, so owning shares means you own a percentage of the company. The second thing to understand is how the stock market actually works. So a stock's price at any given moment is just based on whatever it last traded for. So a stock's price is not somehow set by the company or something like that. It's literally just whatever it last traded for. And this trading activity happens between people just like you and I, and also institutional investors that are buying and selling on behalf of other people. This would be, for example, pension fund money managers, etc. So all of these people that are doing all of the buying and selling are collectively setting the prices of stocks. In a perfect world, every single one of these participants would be exercising Spock-like rationale and decision-making every single time they buy or sell a stock. But the reality is there's a lot of emotions involved in the process. The collective is very susceptible to becoming both overly enthusiastic and overly pessimistic about the future of the companies that they're buying and selling shares of. of. Now, on top of that, a lot of the participants, the majority actually, in the collective of people that are setting the stock prices, are not doing so while considering the fact that owning shares means that you own a percentage of the company. But rather, they're doing their buying and selling as someone who is speculating on what the rest of the collective is thinking and is likely to do. The best way to explain this is if you think of a beauty contest where you need to choose the 6 most attractive faces from 100 pictures, and whoever picks the most popular faces are eligible to win the prize. So it's not about which faces you think are the most attractive, it's about the faces that you think everyone else will choose as being the most attractive. So if you were trying to win this little contest, it would be a naive strategy to just choose the faces that you personally found the most attractive. For a much better chance of winning this contest, it would be smarter to choose the faces that you believed that the majority of people would perceive to be the most attractive. However, one level further would be actually to consider the fact that a number of participants would be operating on that second level, and so instead choose the faces based on what you believe the average opinion expects average opinion to be. So it's not about which faces are actually the prettiest, and it's not even about which faces the average opinion thinks are the prettiest. In fact, it's about anticipating what the average opinion expects the average opinion to be. And this game could even be played on a 4th level or a 5th level or even beyond that. That makes sense, right? Now, what I just described is known as the Keynesian beauty contest, and it comes from someone named John Maynard Keynes, who was an economist and whose ideas defined economics as we know them today. He also had an excellent stock investing track record over a long period of time, and he's someone that Warren Buffett has often quoted. And this beauty contest analogy that we just talked about was his analogy that he created to explain how the stock market works. So the stock market equivalent to this little analogy would be that investors aren't pricing shares based on what they're fundamentally worth, or even what they believe the collective of investors think they're worth. But rather, investors are pricing shares based on what they believe that the collective of investors believes is the average opinion of their worth. Nonetheless, the point is that the collective of investors are not setting prices of shares purely based on rational analysis of what they're worth. There is this Keynesian beauty contest going on for one thing, and on top of that, emotions are rampant. A lot of people are just buying because of the fear of missing out as they see stock prices going up, or selling because they're afraid of losing money when they see stock prices going down. Ultimately, the main takeaway here is that a stock's price does not necessarily always represent its actual true intrinsic value. In reality, what ends up happening is that stock prices usually over-exaggerate in their fluctuations, meaning that sometimes stock prices can be priced above what they're worth when people are being overly optimistic and overly enthusiastic, and also stock prices can be priced below what they're worth when people are being overly pessimistic or afraid. Now, all of this that I just described is what intelligent investors like Warren Buffett seek to take advantage of and seek to straight up exploit. Their success does not come from playing the game better than everyone else. Their success comes from recognizing the game that is being played and choosing to exploit the fact that that is the game that's being played. Pretty cool, right? And the way that you exploit the game is pretty simple. It's just by taking advantage of the moments when shares are being underpriced by the market. And it also means doing absolutely nothing when there's no favorable opportunities available. All right, so now if you have no intention of picking individual stocks and figuring out what they're worth because you're either just too busy or you're just not interested, and your plan is to just buy low-cost index funds, that is still an excellent choice. And now that you know what you've just learned, you're gonna be better equipped emotionally to handle watching as the quoted market value of your holdings goes down without freaking out and panic selling. It's a fact, and it's actually kind of funny, that on average, investors actually achieve worse results than the result achieved by the stock or ETF that they're invested in. Let me say that one more time. On average, investors achieve worse results than the results achieved by the stocks or ETFs that they're invested in. Now, what I just said probably sounds a little bit bizarre, but once you hear the explanation, it's going to make perfect sense. Because the reason that people do worse than the performance of the actual stock or ETF that they're invested in is because people tend to buy their stocks after a recent stock price increase because they're chasing it. And they tend to sell stocks right after a recent stock price drop because they're trying to avoid further losses. So the majority of investors are actually buying at the worst times and also selling at the worst times as well. And because of this, they do worse than they would have had they just bought and then stopped looking. That makes sense though, right? So ideally, now that you know how it all works, you won't get caught up in that little trap. There's a strategy, which you've probably heard of, called dollar cost averaging. And all this strategy entails is that you buy an equal amount into a low cost index fund every single month, month after month. And the idea behind it is that if you're contributing an equal amount every single month, some months, yes, you'll be overpaying because the stock market will be currently overpriced. However, some months you'll be underpaying because the stock market at that moment is pricing stocks below what they're worth. And the idea is that if you do this over the course of your entire lifetime, you will be on average paying a fair price. That's the idea. Now, for those of us that want to take it completely into our own hands and choose the companies that we want to buy our ownership in, and for those of us that want to exploit the way the stock market works, like how we just talked about, it's time to talk about the concept of investing with a margin of safety. So the idea of investing with a margin of safety was taught to Warren Buffett by his teacher, Benjamin Graham. And this is how Warren Buffett is able to follow his rules of rule number 1, don't lose money, and rule number 2, don't forget rule number 1. So to invest with a margin of safety, you first calculate what the shares are worth. And then you buy your shares at an even further discount to what you've calculated their intrinsic value to be. And that further discount is your margin of safety. Investing with a margin of safety essentially gives you some wiggle room to be able to be a little bit wrong in your calculations of intrinsic value and still turn out a fine result. Isn't that cool? So besides buying with a margin of safety, the other way to ensure that you're investing your money safely is to do very thorough research before you buy. And literally, before you buy anything, ask yourself this question: would I be okay with this business that I'm thinking about buying being the only asset that me and my family own for the next 100 years? If you can answer yes to that question, and you can currently buy it with a margin of safety, then there's a good chance that you've found yourself a pretty great investment. And now a natural next question that you might have might be, how do I calculate the intrinsic value of a company? And so if you want to know the answer to that one, check out this video right here next. Also, as a quick disclaimer, I'm not your financial advisor. I'm just someone that loves investing and has spent a lot of time learning about it and wants to just share the knowledge with other people that are on that journey towards financial freedom. So click here or tap here right now to watch that video next, and I'll see you over there.